Packard designs, manufactures, and distributes light, medium, and heavy duty commercial trucks in the US, Europe, Mexico, and other parts of the world. And in this video, I'm going to highlight why I think this is an undercover and underappreciated and undervalued dividend stock that investors can buy at current market prices. So let me share with you the details on why I think that's the case. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So I'm going to start making my case for why I think Packard is an excellent stock that investors can buy with revenue growth. And then I'm going to look at returns on invested capital and operating cash flow before I share with you the valuation details, which includes my proprietary discounted cash flow valuation model for Packard. Now, revenue growth has been excellent for this company over the previous 2 decades, increasing from 14.1 billion all the way up to 32.4 billion in the most recent trailing 12-month period. I say excellent for the business that it's in. The industry overall is not growing all that rapidly over the previous 2 decades. So this is a compounded annual growth rate of 4.4% for the previous 2 decades, which is solid for its industry. Not an excellent growth rate by any stretch of the imagination if we're looking at all of the industries that exist worldwide. Some of the near-term issues that we need to discuss for Packard include the tariff policy. The United States president is adamant about increasing tariffs on companies that are manufacturing products outside of the United States. Packard will be impacted by the tariff policy for a number of reasons. Most notably is the decrease in demand for trucking as a result of the increase in tariffs. So with the increase in tariffs, you're going to have more localized production. You're going to have a decrease in economic activity and less of a need to transport goods across long distances, which of course is going to decrease demand for trucking. And so the company in the near term, in the short term, will experience the headwind as a result of that. Longer term, however, the industry is likely to continue expanding due to the rising demand for spending money online. And of course, if people are spending more money online, you need more shipping and you need more trucking, because things need to be shipped into warehouses, taken from bigger warehouses to smaller, more regional warehouses. And of course, all of that drives demand for trucking. Longer term, I like its prospects, but in the near term, I think there's going to be headwinds that could impact the company's revenue. The next metric that looks okay for Packard is the return on invested capital at 12%. This is down from the peak level of 18.2% it achieved in the trailing 12-month period ending in 2023. Remember, during the pandemic, people were buying a lot more things online and people were buying a lot more things in general. Instead of spending more money on services, people were spending more money on things. And of course, that was great news for a company like Packard that fulfills a lot of that demand for trucking. And so the shift in consumer behavior has not been good for Packard in the reopening of economies worldwide. But I think consumer behavior, I'm seeing data showing that it's normalizing. People are getting tired of the high prices of going out and spending money away from home. Nearly everywhere and everything you do that's away from home, whether you're thinking about restaurants or theme parks or sporting events or travel, prices for those services have absolutely soared since the economic reopening. If you compare prices for every one of those categories I highlighted in 2025 compared to 2019, they are almost all 50% higher than they were in 2019. That's a huge increase in a short amount of time. And I think after letting out some of that pent-up demand, consumers are now reverting back to a more normalized spending pattern between goods and services. And that's going to be a tailwind for Packard. Similarly, the company's operating cash flow to sales is solid at 12.6%. It's been volatile, but maintaining above double digits over the previous decade. Again, this isn't an explosive growth company. This isn't a software as a service company. So I don't expect this company will generate very high percentages of operating cash flow to sales ratios. It's a heavy capital intensive industry in manufacturing and distributing these light, medium, and heavy duty trucks. They're all heavy when compared to any other kind of business. So it's a capital intensive business. The margins are not going to be great. And that's something that investors need to realize for this company. But you're going to see the benefit of that. And it's that you can get the business at a lower valuation because of these factors about the business. It's not going to sell at these super premium valuations because the characteristics of the business doesn't deserve a super premium valuation. And by the way, I'm getting all of these charts from finchat.io. They were kind enough to offer a discount for all of my viewers that use my link in the description to join the FinChat platform. So looking at valuation, the forward price to earnings at 16.28 is less than the average stock in the S&P 500, which is trading at a forward price to earnings of over 20. So you're getting a business at roughly 20% discount to the average stock in the S&P 500, and it's for good reason. I think it deserves that lower valuation because of the very heavy capital intensive industry it operates inside. And then looking at valuation with my proprietary discounted cash flow valuation model, PACCAR I have at an intrinsic value of $123 a share. Its current market price is only $93 a share, leaving room for significant upside as the company's share price appreciates to its intrinsic value. This is the biggest area for shareholder wealth increase that I see for PACCAR is in the stock price appreciating up to the intrinsic value I've calculated. It's closer to its 52-week low, which was $84, than it is to its 52-week high, which was $119, which would be a valuation that I would see as a fair price for this stock. I wouldn't be surprised if PACCAR stock rises closer to its 52-week high over the next 12 months. And so for all of those reasons, I have PACCAR stock rated as a buy, and it's a relatively undercover and undernoticed business that not many investors are talking about. So it's one that you can consider adding to your portfolios at the current market prices, which I think are attractive. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.